Hey everybody, it's Pete. Good morning. Welcome to a new episode of Stock Trading for Beginners. What we're going to discuss today is something called Dow Theory, and I'm going to explain it and also in the same context, bring it all back together with a really basic swing trading strategy. I think that most of the people that watch these videos, most of the members in the community, probably have a full-time job, like the idea of active trading, but they are not necessarily day trading, and quite honestly, maybe even don't want to day trade, but they want to be involved. They want to be in control. So we're going to discuss what Dow Theory is, how to spot the trends of Dow Theory on charts, how most people do it, and then we're going to dig into looking at the stocks in the Dow Jones 30 and whether or not those are good swing trading ideas and how to at least identify being on the right side. If you could do me a favor, please, if you find these videos helpful, definitely click down and subscribe to the channel. That would mean the world to me, and it will mean you get updates too, which would be kind of cool. If you have any questions about the video that we're going to do right now, just leave a comment below the video and I'll get back to you as soon as I can. So we're going to head over to the screen, and just remember, what we're identifying right now is the correct trends that match your resources, your goals, whether or not you want to be an active trader or hold trades a little bit longer, or maybe even do what's called position trading or a little bit longer term, maybe even borderline investing, okay? So we're going to look at the charts, but first we're going to explain Dow Theory. Essentially what Dow Theory states, and this goes back, way back to the beginning of the stock exchange, literally Charles Dow from Dow Jones Industrial, so it's kind of iconic that we're going to look at Dow Jones stocks. It basically says that there's always three trends in motion, all at the same time, always at the same time. There's the day-to-day fluctuations. There is the intermediate trend, which is what most swing traders trade on, that intermediate trend. And then there is the longer term, what you might call investment trends. So we're going to take a look at that right now. We're going to take a look at how to spot them, how to use them, and then how to determine which of them you should be watching for your particular goals. That's one of the hardest part of teaching trading or getting involved in the markets, is really ultimately determining what time frame is right for you. And it probably the biggest determinant of that makes it the correct one, and correct is always, again, relative to everybody, is how much time do you want to spend in front of a screen? How much time do you want to watch watching quotes and getting in and out of positions? Do you want to make one trade a day, 10 trades a day, which is more day trading? Do you want to buy on Monday and sell on Friday? Do you want to ride the current trend as long as it happens? You get an alert and then maybe you get out of the trade. Only you can answer that yourselves. But what we're going to do today is give you basic swing trading strategy, and then you could mold it to your own personal resources, your own goals, all of that kind of stuff. All right. So we're going to head on over to the screen. The first thing we're going to take a look at is Dow Theory. So again, we just mentioned Dow Theory. It goes way back to the beginning of the stock market, and you could do your own research here. But what's super interesting is that the three primary types of trends that are in the market all the time, the longer term trend is more of an investment type trend. Okay, so we want to get that out very quickly. So what we want to do now is we have a list of stocks of the Dow Jones Industrial Average, and we have nothing on the chart right now. Okay, let me actually get rid of that. So this is just pure price action. If you happen to be a new trader, it can look kind of chaotic. And the reason that most people break the market down into different factors, into different trends, into different what's known as multiple time frames, is that it kind of makes it easier to watch in the time frame that matters to you. So I'm just going to bring these out in a little bit more clarity. So we talked about three different trends, and there's the day-to-day fluctuations, and we might even term that even more detailed as the momentum trend, okay? And this is really the quickest price action, and most people will be looking on that as the 10-period moving average. Now, a question that we get all the time is, what exactly is a moving average? So if you can imagine, and I'm actually going to bring this over here into old school bar charts. And you know what, let me go back to candlesticks. It's probably easier to see. So the color of the candlestick represents where it closed. So the green candlestick means that it opened down here and closed up here. And every single one of these candlesticks has an open and a close, as well as a low and a high. So a green candlestick means that it opened down there and closed above the open. That's why it's green. A red candlestick means it opened up there and closed down there. That's why it's red. So this moving average is technically connecting the dots of all of the closes. And in this case, because it's a 10-period moving average, it's collecting the closes going back 10 periods. So every 10 periods, a new average comes based on the price at which it closed, and that's why it's a moving average. So the 10-period moving average is what we would call in Dow theory the day-to-day fluctuations. It's the most recent price action. So again, just breaking it down into the simplest swing trading strategy, you would look for entries above the 10-period moving average. Super simple, a little bit more active, right? So you can quickly eyeball right away like this if you want to be active, and if the stocks that you like, for whatever reason, you want to be active in them, you would just pull this up very quickly and you would notice the difference between Microsoft. Although they both traded strong yesterday, Microsoft has been in a momentum bullish move recently, and you'd be looking to buy that as a short-term trade. Visa, on the other hand, has been in a selling environment as far as the day-to-day fluctuations, the more recent, the much more active participant. So if you're looking to buy stock, you would not be looking to buy Visa right now. Microsoft would be a better situation right now if you are what they call bullish. Now, we're not going to get into right now what we call tape reading. Tape reading is buying and selling at what we call the optimal entry. And the optimal entry is the greatest distance between the entry price and your potential profit target. So today we're just going to talk about Dow theory, the trends, and determining for you. So in other words, when you watch the video, you can make a decision. Do you want to be involved in the market every day, pulling it up? Is it above the moving average? Is it below the moving average? The shorter the time frame, the more you're going to have to watch the market and make decisions. So that was a good, very quick eyeball, right? Both stocks strong yesterday, but Visa is going down. Now, the interesting thing here is this is really where the powerful fast movements and fast decisions come. So now Goldman Sachs, you can see since November, once it started trading above the 10-period simple moving average, it stayed there for multiple months. So even despite the fact that this is the faster moving average, the more active swing trader, the line in the sand very quickly where you'd be looking for more quicker type price action, it actually showed tremendous strength over that time period. And there was, depending on your entry, there really wasn't any reason to exit the trade. And this was a longer term, but very active position that just worked out perfectly. So we got three really good examples there. Microsoft active recently, Visa in a selling mode in this shorter time frame. And again, selling means bearish, so you know the terminology. So you wouldn't be looking for a spot to buy. So think about that. Right away, if you want to be a little more active, Visa would not be one of the stocks that you're looking to buy. And Goldman Sachs, pretty interestingly, maintained its buying pressure over November, over December, and half of January. For 2.5 months, Goldman Sachs met all the criteria to hold on to that trade. It was fast, it was obvious, and it was a really good opportunity that you could have been in as an active trader. Now we're going to go out a little bit further. We're going to go out to what we might call the intermediate time frame. And this is one where you're not going to be looking for entries actively. You're probably going to be going out to maybe make one trade a month or something along those lines. And we're going to start to combine moving averages now, where we put the 50-period moving average. And these are all simple period 50 moving average. Now, if you like to make less trades, and again, we're not going to get into the opportunities. It could be a breakout, it could be a consolidation, it could be a pullback, whatever meets your criteria. You will now use the 50 because you know I want to be involved in the market, but I don't want to be watching it every day. I just want to know if it's above the 50-period moving average. As long as it is, I'll look for buying opportunities to hold a little bit longer. Maybe as a simple signal, as long as it's above the 50-period moving average, you continue to be a buyer. And again, just putting a simple exit strategy on there. Maybe when it trades either below the 10-period moving average, that might be an exit. Maybe when it trades the new lowest low of the last 10 days, maybe that's a different exit, completely up to you. So now we're combining scenarios, and we can actually even make what we just discussed even more powerful by basically saying if the 10-period moving average is above the 50, that only then do you start to look for active trades if you're an active swing trader. The 50-period actually has a similar what we'd call a line in the sand, or a way of determining if you should even be in the trade. But before we get to that, I just want to look over here. So in this situation right here, where the 10 is actually below the 50, you would not be looking for an opportunity to buy until it crossed over here. So over here would be kind of the alert that you would then go in and look for an entry signal. And then let's just say, for argument's sake, the low of the last 10 days would be your line in the sand to get out of a profitable trade. So you can see that not only can you determine which side, but then you can add a filter before you even look for a new entry. And then if you're somebody who has a full-time job, maybe you just want to watch one stock over the year or over 6 months, then you would add what's known as the 200 period moving average. And this is a much, much longer line in the sand for a longer term bullish and bear market. And you can see how many, many different stocks. Let's actually go into Apple so you can see the different scenario that we just looked at. What might be the perfect scenario of looking at Goldman Sachs from November to mid-January, where Apple has been above and below, and you obviously had to make a lot more active decisions. So maybe during this period, you were looking to buy for, let's say, mid-November up until the end of December. Then it became bearish in that active time frame for active traders. Again, if you want to be a little bit more involved, then it became another buying opportunity. So you can see how the moving averages immediately bring your focus into the time frame that's right for you, and only if it meets that criteria, then do you look for entries. Then the little bit longer time frame, the 50 period moving average, you're maybe making 1 or 2 trades a month. You're not really looking to be that active. And then there's the much longer one where maybe you got a full-time job and you don't even want to, you just want to have something to talk about at a barbecue when the world gets back to normal. So what's kind of fun here is you can start to go through all of the different stocks that are in the Dow, and you should be able to immediately determine, is there even something to do? And that's really a big part of trading. Is there something to do? And if there is, then you break it down a little further and you get into your entry. So again, we could just have a really super simple swing trading strategy where, let's just say for argument's sake, you only look to be a buyer if the stock is above the 50 period moving average. So that's the first criteria. The second criteria is you buy every time it makes a new 5-day low, and you continue to buy as it moves in your favor. And then as it pulls back, and so here would be a 5-day low and it's above the 20 period moving average, you buy as long as it's above. And then when it makes a new 5-day low, that's when you exit the position. So these are just kind of the ideas to stimulate your thought process to start to build your own swing trading strategy. But here's the key. And I'll give you a real strategy. Let's say you buy a 5-day high, as long as it's above the 20 and as long as the 50 is also below that. So you have price action up here. You have the 10 period moving average, and then you have the 50. As long as the 10's above the 50, only then do you look for opportunities to buy. And let's break that down even further. So let's just say, for argument's sake, your first entry signal is when you get a new 10-day high and it closes above that 10-day high. So the first scenario, you know what, let's go back to the chart just so we could really bring it home, right? And let's actually go back to, let's keep going through the charts and see if there's something. Okay, so let's use Caterpillar here. This would be an interesting one where the 10 period moving average is above the 20 period moving average, the 50. So you have the 10, the 50, and the 200. So that meets the criteria for you to even look at an entry. But now we break it down a little further. You're not looking for an entry unless the stock price is above the 20. So that's this situation here where the candlesticks are now above the 20 period moving average. So let's just say, for argument's sake, that these signals are super simple. A new 10-day high or a new 10-day low. So a 10-day high is the entry, a 10-day low is the exit, as long as it meets this criteria, and that's what they're called in the right order. And these represent Dow theory, as we just discussed. So a new 10-day high, you stay long that, you continue to be in that trade until you make and close as a new 10-day low. So this new 10-day high, that's the buying signal. You did not make a new 10-day low and close there. This here actually was pretty close. Maybe you got stopped out there, maybe you didn't. If you did, fine, then you re-enter on a new 10-day high. If you didn't, then you write it up. And then when you get a new 10-day low and you close below that 10-day low, that's the new exit. My goal here today is to give you focus. My goal here today is to give you structure. So now you can go and play with this and you'd be like, okay, how often do I actually want to trade? That's really the big key. Do you want to trade every 5 minutes? Do you want to trade every 5 days? Do you want to trade every month? That'll determine, do you look at the daily charts? Do you look at the weekly charts? Do you look at the 10-period moving average and only then do you look for entries? Do you want to be a little bit less active? Then maybe you look at 50 and then look at those same entries. So think about what we just said, the entry signals just to start out and the exit signals to start to what they call back test, or maybe go look at your favorite stocks and see if they met the criteria. You're like, oh my gosh, what was I doing? Why did I even get in that trade? There was no reason to be in it, like we showed you Visa, right? So you start to look for new 10-day highs where it closes above the high of the last 10 days. As long as it's above the 10-period moving average and the 10 is above the 50-period moving average, that's the signal for you to start looking for entries. Then the entry is the 10-day. And as long as that keeps moving in your favor, you stay in that trade until you get a new 10-day low that closes below the 10-day low. Very simple, very easy to follow, and it's the most basic one that you could possibly look at. It's a breakout swing trading strategy in the direction of Dow theory, in the direction of 2 different or 3 different, if you add the 200 period in there, 3 different trends happening at the same time. But what the moving averages do, they give you focus, and what that entry and exit system that I just gave you is, it makes it very easy, because now you got to just look at that and be like, oh, there's a new 10-day high. Does it meet the other criteria? Or you could even do it the other way around. Well, the 10 is below the 50, so there's nothing to do. Or the 10's above the 50. Okay, now let me take a look and see if there's an entry signal. Okay. If you have any questions about this, definitely click down, subscribe to the channel, and leave a comment about this strategy. I'd love to hear your thoughts. And if you have any tweaks to it, let me know. It'd be kind of fun to go back and forth. Have a great day.